Welcome to the Pro Ticker Deep Dive. Today, we are strapping in for what really looks like a monumental shift. Our analysis suggests we're staring down the barrel of, a once-in-a-generation macro rotation.
Yeah, it feels like that.
Policy, clean technology, and just cold, hard geopolitics are converging with immense force. We're diving deep into what looks like the structural backbone of the next industrial age.
And what's fascinating, I think, is the core question here. Is the world kind of reliving that strategic energy build-out we saw back in the 70s and 80s?
Right.
But this time, it's driven maybe less by pure defense and more by, well, the sheer necessity of decarbonization and national security.
Okay.
Our mission today is to really analyze the evidence. We're focusing specifically on three materials right at the center of this rotation: uranium, rare earths, and copper.
Absolutely. And the key takeaway we want you to have right up front is that this is much bigger than just, an isolated energy trend.
Much bigger.
We're seeing a complete blending of industrial policy, national security, and the green transition. These specific metals, nuclear power, they're suddenly being reclassified as core strategic assets for the 21st century.
That's the heart of it.
Okay, so let's unpack this macro shift: atoms, electrons, and policy. We're living through a kind of strange energy paradox, aren't we?
Mm-hmm.
The world's pushing hard for decarbonization, yet at the same time, we see this significant pivot back to nuclear power. I mean, for decades, nuclear was politically toxic, economically questionable. Why this sudden, decisive global pivot now?
Well, the primary driver, honestly, is a recognition of reality. Policymakers seem to have finally accepted the critical limitations of trying to build an energy grid solely on intermittent renewables.
The sun doesn't always shine, the wind doesn't always blow,
Yeah.
that kind of thing.
Exactly. We're talking massive land constraints, grid storage problems, and just the fundamental inability of solar or wind alone to provide that global baseload power to dinner 47. Nuclear has been successfully repackaged, and correctly, I think, as the only proven scalable source of carbon-free baseload energy out there.
So if oil isn't the main focus anymore, what's defining energy independence today? Because that feels like the crucial shift in national strategy.
It's no longer about securing barrels of oil. It is absolutely about securing electrons and isotopes. That's the new currency.
Electrons and isotopes. Okay.
And this realization, it's triggered an intense state-led policy realignment. Western nations, the US, Canada, the UK, they're now in a full-blown race to reclaim control of energy and material supply chains that have been heavily dominated by Russia and China for years.
And the policy tools they're using, they're fundamentally different from the old subsidies, right? We're not just talking grants or tax credits here.
Precisely. And this is the crucial distinction. We're seeing direct government equity stakes, strategic loan guarantees, military-linked procurement deals for critical energy projects. The U.S. Department of Energy, for instance, has pivoted. They've gone from just handing out subsidies to effectively de-risking private capital by taking direct ownership positions in strategic projects.
Okay, what's the implication of that mechanism, taking actual ownership?
It fundamentally changes the economics of resource development. When the government provides, say, a guaranteed long-term offtake contract or takes an equity stake,
It lowers the risk for private investors?
hugely. It ensures these projects, whether it's domestic uranium processing like Centrus Energy or lithium mining like Lithium Americas, are defined as national necessities. That signals a whole new playbook. Economic security is national security now.
That's a powerful signal indeed. So if the policy is pointing decisively toward nuclear, then the engine driving that shift has to be its fuel. Let's transition to the first of our three core materials, uranium. Talk about a dramatic market change. This was the forgotten metal for nearly a decade after Fukushima.
Oh, absolute forgotten. Prices cratered below $20 a pound. It was dead in the water.
And now, we're looking at prices comfortably above $90. What happened?
It's a classic re-rating. It's driven by a structural deficit that is only getting bigger. We've got rising long-term demand fueled by global reactor restarts.
Japan's bringing reactors back online.
Japan's reactivating its fleet. South Korea is now actively exporting its nuclear tech. And then there's the promise of small modular reactors, SMRs. But honestly, the most immediate powerful factor: government strategic stockpiling.
Because nations realize they must secure non-Russian supply.
They have to. It's become a security imperative.
We hear about SMRs constantly, but, is that timeline realistic? Aren't we potentially overhyping a technology that's still maybe years away from really moving the needle on global uranium consumption?
That's a really crucial point, and it balances the optimism. You're absolutely right that SMR commercial deployment is probably still a 2028, maybe even 2030 plus story for true scale. However, the immediate demand drivers are those government mandates. The US and UK have pledged full independence from Russian uranium by 2028, that hard deadline. It forces utilities to sign high-priced long-term contracts today to lock in that future supply.
And this demand isn't just a Western thing, is it?
Not at all. It's a global rush. Besides the major Western economies, even the Middle East is now getting into the nuclear game. Saudi Arabia's planned reactor fleet. That marks a significant geopolitical move. It guarantees further long-term demand pressure on this market.
And to bring the reality of the scarcity to life, you just need to look at the actual mining projects. Legacy producers like Chemico, Kazatomprom, they're running near full capacity, right? And struggling to meet demand.
They are. They're pushing hard, but the demand is outstripping the easy supply. That's why we're seeing major capital flows into restarting mothballed assets.
Like Paladin Energy.
Exactly. Cape Paladin, they're reviving their Langer Heinrich mine in Namibia. That mine was shut down years ago because prices were too low. Now, production is being ramped up at, frankly, breakneck speed.
And that tells you the market can handle higher costs.
It's the clearest signal possible that the market is willing to bear significantly higher costs just to bring capacity online and fast.
And the capital is also being deployed to fast-track future assets, too.
It is. Paladin's recent major capital raise was specifically earmarked to push the Palliserson Lake South Project PLS in Canada's Athabasca Basin toward a final investment decision within just 2 years.
Why is the Athabasca Basin so critical?
It offers the world's highest-grade uranium deposits, so fast-tracking a high-cost but high-grade project there confirms absolute confidence in sustained high prices for the decade ahead, at least.
Okay. High grade needs high prices. Makes sense. Now let's shift gears a bit. Rare earth elements, REEs, these are often discussed more quietly, but they seem incredibly strategic.
Quietly vital.
If nuclear needs fuel, the wider green transition and defense sectors need magnets. What makes REEs the new oil of industrial tech, as some call it?
They are simply indispensable. They are critical components for pretty much every piece of high-tech machinery driving this macro rotation we're talking about.
Like what specifically?
EV motors, those gigantic offshore wind turbines, advanced robotics, and crucially, modern missile guidance systems and defense hardware. You simply cannot execute the green transition or maintain a modern defensive posture without a reliable supply of rare earths. Period.
But that supply chain, it's a massive geopolitical bottleneck, isn't it?
An existential one, frankly. China currently refines over 90% of the global supply of these elements.
90%? Wow.
Yeah. That level of concentration is the primary driver of policy action in the West. And what's truly fascinating is the coordinated response we're starting to see internationally.
You're talking about those unprecedented G7 and EU talks, trying to set a price floor for rare earths. Setting a price floor that sounds like extraordinary market intervention.
It is extraordinary. And it's a profound admission that the free market, left to its own devices, simply cannot solve this dependency problem quickly enough.
So the G7 is essentially willing to pay a strategic insurance premium.
That's a good way to put it. By setting a guaranteed minimum price, they hope to incentivize non-Chinese, currently higher-cost producers, say in North America or Australia, to actually start production and, crucially, stay viable. This isn't just market meddling. It's seen as a strategic cost nations are willing to bear to build a diverse, secure supply chain.
That clarity, though, even if it's through market intervention, that's what drives investment, right?
Yeah.
Looking ahead, what are the core demand drivers beyond just EVs?
Demand growth is projected at a pretty hefty 9% annualized rate through 2035. And yes, it's powered by the EV build-out, but increasingly it's things like physical AI, advanced robotics, and next-gen defense manufacturing.
Physical AI.
Think robots that interact with the real world, advanced automation. Anything that moves precisely, senses its environment, or computes quickly relies heavily on rare earth magnets.
And we can actually see the market reacting to this policy clarity now. REE stocks like MP Materials or Aclara, they're showing these classic basing patterns after a multi-year downtrend. That suggests investor interest is finally reigniting.
Policy certainty is the cure for investment uncertainty in these deep capital sectors, right? Once the market understands that governments view this as a genuine national security issue, the whole investment calculus changes.
Okay, finally, let's turn to copper. The quiet hero of electrification, maybe.
Huh. Yeah, the nervous system of the modern economy is a good description.
It's everywhere. EV wiring, grid infrastructure, data centers, and its demand profile is now being redefined by this convergence we're discussing.
Copper really is the conductor of everything, and the market is extremely tight right now, partly driven by a pretty shocking supply event.
What happened?
We're facing an immediate supply shock because of a forced production halt at Freeport's massive Grasberg mine in Indonesia. A mudslide there knocked out a significant chunk of global supply.
Can you put the scale of that loss into context for us? How big is Grasberg?
Grasberg is one of the world's absolute linchpin copper hubs, losing potentially 35% of its expected output. And knowing it will be a slow ramp-up lasting well into 2027, that's not just a temporary hiccup.
No.
It's like removing an entire major project's worth of supply from the market for years. This is the primary cause of the immediate deficit traders are grappling with right now.
So supply is under serious pressure, but demand is accelerating, partly because of AI. I have to pause there. You mentioned data centers needing 3 to 4 times the copper.
That's right.
That implies the AI boom isn't just some abstract software thing. It's a massive physical, materials-intensive build-out.
The scale of that infrastructure demand is enormous and, I think, still broadly underestimated. AI data centers built for these huge computational loads require 3 to 4 times the copper compared to traditional facilities per megawatt of capacity.
Per megawatt.
And this AI infrastructure build-out, it's global and it's accelerating rapidly.
It really sounds like a perfect storm for copper prices.
It is looking that way. New large-scale mining projects are incredibly scarce and take ages to bring online. Meanwhile, demand just keeps climbing, fueled by both electrification and this AI surge.
And prices reflect that.
Yeah, prices have pushed significantly towards $11,000 per metric ton recently. Traders are bracing for at least a 6-month structural supply deficit. It really confirms copper's role as this indispensable macro hedge for the 2020s.
Okay, we've covered uranium, rare earths, and copper. Let's try to synthesize the supercycle opportunities here for the listener. What's the key insight connecting these 3 vital materials?
I think what really connects them is that their long-term demand curve is increasingly being dictated by government policy, by national security, by defense spending, not just by cyclical consumer demand.
Which creates specific opportunities.
Exactly. That leads to, I'd say, 5 key opportunities we can see emerging.
Okay, let's hear them, starting with the nuclear renaissance.
Right. First, the nuclear renaissance means governments are investing directly equity stakes, national backing in key players all along the supply chain. That's miners like Paladin, fuel companies like Centrus, even reactor tech firms like NuScale and TerraPower.
Okay, number 2.
Second, strategic metals, REs, uranium, are being fundamentally reclassified as national assets. This political support creates a kind of sustained floor for both demand and pricing. Third, we're seeing institutional capital rotating decisively into hard assets. This is driven by 2 big themes, hedging against stubborn inflation and betting on these long-term energy security imperatives.
Makes sense. Fourth,
SMRs and those advanced reactors. They're rapidly moving out of the purely theoretical phase and towards tangible commercial rollout before 2030. That guarantees a long-term accelerating need for uranium consumption down the road.
And finally, number 5.
And finally, electrification, especially when coupled with this massive AI infrastructure build-out, is creating highly specific copper-intensive demand profiles that, frankly, just didn't exist even a few years ago.
That's a powerful confluence of demand drivers, no doubt. But we have to caution the listener against pure, unbridled optimism. What are the necessary risks we need to keep in mind when looking at this potential supercycle?
Absolutely. Caution is warranted. First, we have to acknowledge inherent policy volatility. Incentives can shift, sometimes dramatically, with changes in administration or geopolitical winds.
Sure.
Second, we need to be realistic about potentially overhyped timelines. Many of these SMR and rare earth projects are still years away from producing commercial metal or power at scale.
Delays are common in big projects.
Very common. Third, geopolitical shocks reign a huge risk. Think about potential unexpected export restrictions from Russia or China that could severely distort global pricing almost overnight.
And lastly.
And finally, we can never forget that mining always faces environmental and social resistance. Local opposition can, and often does, delay or even derail even the most strategically important projects. ESG concerns are real.
Okay, so putting it all together, what does this all mean for the future? We've looked at what seems to be the structural backbone of the next industrial cycle, driven not by, wishful thinking, but by hard strategic national necessity.
Hmm.
The world is fundamentally rebalancing around energy resilience, and this convergence of AI, defense requirements, and the mandated clean energy transition seems to guarantee an intensified, almost non-negotiable appetite for these three specific materials.
I think if we connect this to the bigger picture, we're moving toward a future where prices for these materials don't just rise cyclically, like they have in the past. They seem set to re-rate structurally.
Rewrite structurally,
Yeah.
meaning a permanent step change higher.
Potentially.
Yeah.
Because the long-awaited belief in the nuclear and strategic materials story has finally collided head-on with undeniable physical scarcity, the world's energy future. It probably won't be written primarily in solar panels or oil rigs alone. It looks like it'll be forged in the deep supply chains, the reactors, and the mines that not long ago many thought were obsolete.
A future forged in mines, reactors, and supply chains. A powerful thought to end on. See you all the next Pro Ticker Deep Dive.